Hi everyone, this is Wall Street Farmer. Today's November 7. I just published a trade idea on TradingView, mostly talking about my view on where the stock market would go in the remaining of the year. The Fed already raised interest rate 6 times. It probably raised another one next month. So now we're looking at a 4% Fed fund rate. By next year, when everything's done, we're probably looking at the minimum interest rate at 5%. And this is almost 5% over the original interest rate a year ago at 0 to 25 basis point. So where the stock market would go, uh, 2 months ago, I published a series of ideas called the Great Wall Street Repricing. The basic foundation is high inflation rate and high interest rate replace the low interest rate and low inflation environment and become the fundamental assumption in all investing. So all the stock, all the commodity should be repriced based on that. And we are looking at just the stock today. Based on the discount cash flow model, a company, the valuation is the present value of its future cash flow. High interest rate raise its cost of capital. High inflation rate also had a bad impact because it raised the cost of operation, raised the cost of goods sold, and also if the company raised the sales price, the sales volume will go down. So the end result is a lower free cash flow. So we are talking about a smaller cash flow on the denominator and then a bigger discount rate at the denominator. So the end result is a much lower stock price. So today I'm using a new concept called Gordon growth model. Basically, very similar to the discount cash flow, it state the company's intrinsic value is the sum of its present value for the future dividend. But unlike the discount cash flow that you calculate cash flow one at a time, is using a terminal period dividend and divided by the difference between the required rate of capital minus the growth rate. So when we look at the end of last year, so everything looked good at the time, right? So we're looking at the bond rate, BBB bond rate is under 3%. So I'm using as 4% as a corporate borrowing cost. And then the perpetual growth rate at 2.5%. I think it's very reasonable. Anything below 3% is pretty reasonable. So based on that, $1 per share dividend will translate into a $68.33 stock price. So at the end of last year, S&P closed at 4766 point the last trading day. So now see what happened now. First, the Fed fund rate is already 4% from 0 to 4%. And I just mentioned I expect to go up to 5%, right? So based on that, the corporate bond rate right now, the BBB is already 6.3. So based on the increase with the risk-free rate, assume the new R will be 7.5%. So with the pending recession, of course, the growth rate will go down a little bit. I'm not particularly say it's going down a lot. It's a soft landing. So it's go down from 2.5% to 2%. But just because of that, see the impact from $68 now is to $18. And but look at the stock price. We only went down 20% from 4,700 to 30 today 3,800, right? The S&P 500. So it's only down 20%. But if you look at the value here, it's down 73%. It's by that magnitude imply the stock index could go further down 2,400 points from here to basically 1,300 points or down another 65%. So this is one angle to look at the stock market based on its fundamental value. A company stock price are very vulnerable to rising interest rate and slow growth. So that's basically you can disagree with the model. You can use different assumption. They come up with very different answer. But we are looking at the rising interest rate and slow growth. That's kind of like the certainty we have that indicate the stock value right now is too high. So of course the trading idea is short the stock index future, and as long as the Fed still tighten the money supply, so I think the logic is still very good. Um, Thank you very much. I hope everyone will go out to vote tomorrow, as I will, and I will talk to you soon. Bye bye.